Imagine this: three friends, Arav, Neha, and Vikram, team up to launch a cloud kitchen. They invest rupees 4 lakhs, 3 lakhs, and 2 lakhs, respectively. By the end of the year, their business earns a neat 90,000 profit. Now comes the real challenge: how do they divide the profit? Should it be based on how much they invested? On who worked the hardest? Or just split equally? That's where the concept of distribution of profit among partners comes into play, one of the most crucial pillars of partnership accounting. In this video, we'll unpack the rules, the methods, and the logic behind how profits are shared fairly in any partnership. In a partnership, how profits and losses are shared depends on one key document, the partnership deed. This agreement can spell out the exact profit-sharing ratio, salaries or commissions for active partners, interest on capital for money invested, or even interest on drawings when partners use firm funds for personal needs. But what if there's no written deed? Then the Indian Partnership Act 1932 takes over by default: profits and losses shared equally, no partner gets a salary, no interest on capital or drawings. The takeaway? A clear, written deed isn't just good practice, it's your best protection against confusion and conflict. Once the firm figures out its net profit or loss through the regular profit and loss account, the next step is all about sharing, and for that, we use the Profit and Loss Appropriation Account. Think of it as the profit-sharing blueprint. Here's how it works. Start with the net profit. Then subtract interest on capital, partner salaries, commissions. Then add interest on drawings charged to partners for using firm money. What remains is called the net divisible profit, and that's split among the partners based on their agreed ratio. This account ensures that every partner gets exactly what they're entitled to, no more, no less. Let's make this real with a quick example. Imagine a firm with two partners, Amit and Rashi. The net profit for the year is rupees 1,20,000. According to the deed, interest on capital is 10%. Amit has invested 1 lakh, Rashi 50,000. Amit also receives a 5,000 salary. And they share profits in a 2:1 ratio. Here's the step-by-step. Step 1. Interest on capital. Amit gets 10,000, Rashi 5,000. Step 2. Partner salary. Amit earns 5,000. Total appropriations so far is rupees 20,000. Step 3. Remaining profit 1,20,000 minus 20,000 equals to 1 lakh. Now, divide that in a 2:1 ratio. Amit gets rupees 66,667. Rashi gets rupees 33,333. And there you have it, a clear, fair distribution using the Profit and Loss Appropriation Account. Profit sharing isn't just about salaries and capital, it goes deeper. Let's look at 3 common adjustments that often appear in partnerships. Interest on drawings. When partners withdraw money for personal use during the year, interest may be charged. This amount is credited to the firm and recorded in the appropriation account. Commission to partners. Some partners might earn commission for specific roles, like achieving sales targets or managing operations. Guaranteed profit. At times, a partner is promised a minimum profit. If their actual share falls short, the difference is paid by the other partners based on their ratio or agreement. All these adjustments are handled through the Profit and Loss Appropriation Account, making the profit-sharing process fair, accurate, and completely transparent. So, why does all this matter? Because partnerships aren't just about numbers, they're built on trust and transparency. Whether it's a family-run business, a law firm, or a fast-growing startup, each partner brings something different: money, time, or talent. Without clear accounting, one partner might feel shortchanged, Another might unknowingly take more than their share, and conflicts? Almost guaranteed. That's why proper profit distribution isn't just accounting, it's relationship management on paper. Now, here's a twist. What if the firm ends the year with a loss instead of profit? The rule is simple. Losses are shared in the same ratio as profits. But there's one catch. No interest on capital or salaries can be given unless the partnership deed specifically allows it even in loss years. It's a reminder that in partnerships, just like in life, you don't just share the gains, you also share the risk. Let's quickly recap. Profits and losses are shared as per the partnership deed. No deed? Then the law steps in, equal sharing, no interest, no salaries. The Profit and Loss Appropriation Account ensures every adjustment, interest, salary, drawings is properly recorded before profits are split. Coming up next, we'll take this from theory to practice. Get ready to prepare the account step by step with journal entries, formats, and examples. Stay tuned and sharpen your ledgers.